Hello and welcome back to another episode of the Coreco Couch that will become your go-to vodcast for everything mortgage related, hosted by me, Andrew Montlake, but you know me better than that by now. Call me Monty. I'm delighted to be joined by my very special guest, Jennifer Nursiah, who is one of our partners here and one of our longest serving brokers at Coreco. Jen began her career in financial services back in 2004 and has a wealth of experience, allowing her to gain a full understanding of a client's holistic financial situation. She started here in 2011, I believe, as one of a few female brokers in a predominantly male-dominated industry, and she smashed glass ceilings all the way. Hello, Jen.
Hi, Monty.
Welcome to the Coreco Couch.
Thank you very much for having me
feeling
on the
relaxed?
Coreco Couch. As relaxed as I can be, yes. Thank you.
Don't worry. No one's watching. We're here to talk about something which actually I've always found a little bit mysterious, and I've tried to understand it throughout my career, bridging finance and how that actually works. So we get a lot of calls about people who want to move quickly or they want to do certain things. And whenever the concept of bridging finance comes along, I always go, oh, do you know what? I'm going to introduce you to yourself or one of the other specialists. So do you want to tell people sort of what bridging finance is in a nutshell?
Yeah, sure. So bridging finance is a short-term type of finance. So if you think about a normal mortgage, that's typically taken over 25, 30, 35, sometimes longer years, whereas a bridging loan is taken typically over a maximum of 12 to 18 months. And it serves very much as a bridge or plugging a gap when people have a situation where they need money quickly. That's when a bridging loan can come into place. So, for example, at auction finance, or if somebody hasn't sold their house and they need to buy quickly, those are good examples of when a bridging loan might be needed.
Is that the typical scenario you find for your clients who need it?
Yeah, for my clients, it is if they need to move quickly. So speed is often a requirement for bridging. People that are looking at buying properties with short leases, so there might be some legal work in the background that's going to take a longer period of time, but they actually need to buy the property quickly. So not all traditional mortgage lenders would lend, for example, on a short lease, on a property with a short lease.
Yeah. And what about if the property needs a lot of work doing to it as well? Is that a situation where a traditional lender might come in and go, do you know what, it's not worth what you're paying for it, or it's a shell or that type of thing?
Yeah, absolutely. So a traditional mortgage lender will need a property to be habitable before they'll lend on it. And actually, in today's environment, they also need to be, generally speaking, rated A to E for the EPC requirement as well. So if a property doesn't meet those standards, you often will struggle to get traditional lending on it. And it might not take very much work to bring a property up to scratch, but it might take time, and it might be time that people don't have in terms of being able to purchase quickly. So those are good examples as to when a bridging loan might be required.
And so one of the things that I always find is when you start talking about bridging loans, you start talking about the rates and the fees, and that's where some clients sort of switch off. What is the type of difference in terms of costs and fees and rate differential that people might see?
Yeah, so bridging loan is definitely more expensive than traditional financing, both on the interest rate and on the fee. It's a higher risk type of lending. So lenders that are in that space do price for the risk that they're undertaking. I mean, in terms of differential, it's very difficult to kind of give an example. It's more expensive.
Yeah. And they charge typically they charge per month?
Yeah.
Is it? And then in all cases, how do people pay the interest? Do they pay it monthly, or is it rolled up? How does that work?
Yeah, so lenders will give you the choice. You can either do what's called rolling up the interest, whereby you don't have a monthly cost, but they build it into the overall loan. So all of the interest effectively is paid up front. If you then don't keep the mortgage for as long as you've taken the term for, you will then be given that interest back. Or you can choose to service the interest, but because it's at a higher interest rate, it will be at a higher monthly cost. So it's about cash flow, really. Does somebody want to pay the ongoing monthly payment, or would they rather it just taken as a lump sum?
Yeah. So with all those fees and costs involved, it's about looking at the bigger picture then, I guess, because especially if it's a buy-to-let property or a commercial property that you're doing up or doing some development on, the end goal justifies the higher cost and the means, and that cash flow is really important, I guess.
Absolutely, yeah.
So in terms of the types of lenders who offer this, then you can't just go, this is where you come in, because a specialist advisor is really important, because there's a whole world of different lenders. It's not something you walk into the high street lender and get, is it?
No, absolutely. You wouldn't go to a high street bank necessarily for a bridging loan. It will be a more specialised lender, possibly even a building society. But it is really important that you do still speak to the right advisor and take advice. If there is a way to not have bridging finance, it is likely to be more financially beneficial. So it's important that you're speaking to somebody that is advising the right product and making sure that a bridging loan is the most appropriate solution.
And do you still see a lot of, I use the term cowboys out there in this market, both in lenders and brokers? And how, if you're looking at it, how do you check that actually you're going and getting the right advice from the right people?
Yeah, so I mean, I personally am not aware that, there are still sort of bad practices going out there. There probably are, but certainly at Coreco, the team of experts that do deal with bridging are all very highly qualified, very experienced, and we will be making sure that it is the right solution for the client. Bridging is a lucrative type of financing. So historically, there may have been people that have been recommending bridges when it wasn't the right solution for the client.
Yeah.
But particularly in a regulated space, you have to make sure that the client understands what it is they're entering into, but most importantly, that there is going to be a suitable exit for a bridging loan. You don't want to leave a client in a position where they're going to be left in a vulnerable position in 12 to 18 months.
Yeah, and you mentioned the short-term nature of it. Is there a maximum then that you can bridge for? Obviously, you don't want it to go on too long.
Yeah, so for regulated bridging loans, the term, I believe, is a maximum of 12 months. And for non-regulated, it can be up to 18 months. And there are a couple of lenders who have a longer term bridging loans, but typically you'd kind of want to know why somebody would want to be on a bridging loan for a longer period of time. Typically, when a bridging loan is recommended, the exit is in mind already. You know how a client is going to come out of the bridge. So you'd want to make sure that that is a guaranteed exit. And most lenders won't lend unless they know exactly what the plan is to exit the bridge.
Yeah, that makes sense, I guess. And just explain regulated, unregulated for those who might not be clear what you mean about that.
Regulated lending tends to be more where people are going to be living in the property. So, for example, somebody needs to sell their house in order to buy a new property, but they can't sell their current property and they need to buy the new one. That would be an example of a regulated bridging loan because they are going to move into that property. A non-regulated bridging loan might be somebody's buying a property at auction, they're going to do it up and then they're going to let it out later on down the line. So there's no element of them going to be moving into the property. Right,
yeah, I get it. And can you give me an example of the last time you used a bridge and why did you use it for a client?
So I have a case on my desk at the moment where a client is purchasing a property that only has a 28-year lease.
Right, okay.
Ideally, they'd like to complete the purchase before the property has had the lease extended, and in order to do that, a bridging loan will be required up until the point that the lease is extended, after which point they will then refinance onto a traditional mortgage.
That's a great example.
Thank you.
Right. Well, I think we've covered bridging. So thank you very much for your time, Jen. Thanks for watching, and I'll see you next time, and we'll see who's next on the Coreco Couch.